Good morning, everyone. How are you doing today? Well, thank you for attending. This is our 11th annual Real Estate, High Desert Economic and Real Estate Symposium. I can't believe it's been 11 years. So this event would not be possible without our supporters. We've had great continued support over the years, and I'd like to thank them personally and also introduce you to our title sponsor, Beacon Economics, Dr. Thornberg. Our event sponsor today is retired Colonel Paul Cook, 1st District Supervisor for the County of San Bernardino. Our community sponsor, ISU Armac Insurance. Our gold sponsors today, Southern California Logistics Airport, the City of Victorville, the Town of Apple Valley, Paramount Residential Mortgage Group, otherwise known as PRMG, the City of Hesperia, the City of Barstow, the City of Adelanto, ICR Staffing Services, Touchstone Escrow, and Coldwell Banker Home Stores. Our silver sponsors today are Providence St. Mary Medical Center, Loan Depot, Desert Valley Hospital, Desert Valley Medical Group, and CoStar LoopNet. Our bronze sponsors today, Mojave Copy, Nick Holmes, Edward Jones, Global Credit Union, and Coldwell Banker Commercial Property Management. Please give them a big, warm welcome. Each year we prepare a market watch, and we also prepare for the symposium. And I really want to give special thanks to the people who contribute. I know I am annoying January 15th, calling for information at each of the municipalities and also Chicago Title. So I want to give a special thanks to Bobby Tarango and Mike Arias at Chicago Title, Orlando Acevedo and Linda Duarte from the Town of Apple Valley, Dr. Gil Keenan and Sarah Wang, City of Adelanto, Cody Tompkins and Amy Sanchez with the City of Barstow, Victor Knight with the City of Hesperia, and Tony Camargo and Rebecca Carrillo from the City of Victorville. Thank you very much. And if you see any of the data up on the screens today and you're like, that's not quite right, just blame it on all those people I just thanked. Well, I'm excited to introduce our keynote speaker. Dan Spiegel is the Managing Director of Coldwell Banker Commercial Worldwide. He flew out last night from Chicago to be with us today. He's going to provide a national overview of commercial real estate and tell us how it's going to be a wonderful year. Please welcome Dan Spiegel.
Is that working? There we go. Well, this is going to be hard doing this with my left hand and speaking with my right, so please forgive me. So, Jason, thank you so much for having me. I'm really impressed. I think this is the third year I've been out here, if I remember correctly, and I'm really impressed at how much this event has grown. I know it's probably a tremendous event, both to keep you updated on what's going on in the marketplace, but also as a community event for those of you in this community to network with one another and to source new business opportunities. So congratulations to everybody here, because I think this is a great opportunity to both learn and network. So anyway, Dan Spiegel, Managing Director of Coldwell Banker Commercial. I am based in Chicago, and I will tell you, I am making a quick trip out here. I flew out to Ontario last night, and I'll start this off because I'm going to use my I'm going to use the story of coming out here a little bit as an analogy to the commercial real estate market today. So let's just think for a second, like I did yesterday, you're going to the airport, right? Most of you, everyone's done this, right? You get excited, you pack your bag, you drive, you call an Uber, whatever you're doing. Everything's going to be great about travel, right? What happens next? If you're a frequent flyer, you get an app and it says, you know, your gate is whatever, and the plane's going to be 10 minutes late. And you go, yeah, whatever, they can make that up, right? No big deal, right? And then you get to the airport, and you go inside, and you do through all the security nonsense, right? And you get there, and the next thing that happens is, well, it's now 30 minutes late. And you're like, oh, okay, well, maybe I'll grab a Starbucks or something, it'll be okay. And then it goes on from there, right? So this is, kind of the experience, right? You're looking up like, when's it gonna leave? So by the way, I did have this happen last night. I flew in, I changed planes in Vegas. I got to Vegas on time. I look at the monitor, and flight to Ontario is 25 minutes late, and then it became 40 minutes late. And if it's a really bad situation, what happens? It's like the plane's there, but the flight crew's over their time, and so on and so forth. So anyway, I'm going to use that to talk a little bit about how the commercial real estate expectations have changed over the last year. In the residential business, as interest rates go up, it really changes dramatically because the deal cycle is so short, 30 days, 60 days in residential. In commercial real estate, the deal cycle is much longer. So it takes a much longer time to have an impact on the marketplace. So for example, if you go under contract for a piece of land for development, you have entitlements and you have zoning and other issues. I'm from Chicago. That could take 2 years in Chicago. I don't know what it takes out here. But by the time you get around to all that, and then you go to get capital to do the deal, they're like, sorry, we're not doing that anymore. But anyway, so it's a little bit like the experience of getting excited to go to the airport and then finding out it's delayed and whatnot. So now I'm going to show you another slide, and I'm not in any way making light of this, but which scenario will unfold for commercial real estate in 2024? So let's think about air travel this year. Then remember, this was in January. This was the Japan Airlines plane, landed safely in Tokyo, collided with another jet on the runway. Miraculously, nobody was injured. Well, I suppose the people were injured, but everyone got off safely, which is truly miraculous. And it could be like the soft landing the Fed has been telling us about. We could have a soft landing, and we could have a wild surprise, too. Okay, another scenario could be this one, right? And this one could be everything's fine, you're okay, the expectations, and the door flies off, right? And what the heck is going to happen? So that could be the market this year, too. That could be scenario number 2. Or scenario number 3, and this is from last week. Everyone see this one? United Airlines taking off from San Francisco. A tire fell off and smashed a car in the parking lot. I could go on and on. First of all, I hope you don't own stock in Boeing right now. That's not such a good investment. And then I also heard stories. I think there was one just in yesterday's paper about 2 pilots falling asleep. But anyway, neither here nor there. My point being is simply that, we talk about what's happening in the market, but there's so many variables. It is not a closed ecosystem in commercial real estate. It is an open system. We don't know what'll happen, and we're not sure which way it'll be up. So I'm going to use this as an analogy to talk a little bit about the market for 2024. Okay, so we have tailwinds, right? Those tailwinds are positive things that'll help you make up that delay. And while interest rates are both a headwind and a tailwind, at least the 10-year Treasury note seems to have come down a little bit, and although this past week it's been creeping up, or last 2 weeks, but it seems to be stabilized. And one thing in real estate is you want to take the unknown variables out of the equation the most you can. So if the interest rates have stabilized, that's kind of a good sign. What else do we have up there? So the short-term interest rate, you have user demand. So I'm just driving through here. There is a demand for retail, for example, in most markets, right? Industrial, I know you're a market that's heavily influenced by the industrial distribution market. And yes, I'll show you a chart in a little bit. Yes, vacancy rates have ticked up, but let's keep in mind, we're ticking up from like 0.5% vacant to 3%. That is still a very, very tight market industrially. The residential demand, I'm sure you'll hear about this market in particular, but I think across America, we know there's a shortage of residential real estate. Okay, so those are all positives. And there's buyer pools, international buyer pools, domestic buyer pools, people looking for opportunities in real estate. And as commonly said now, is sitting on your wallet, not sitting on the sidelines, just sitting on your wallet, waiting for that opportunity to take place. Then you have headwinds. So headwinds are the headlines we all read about office space. And unfortunately, I read another one this morning we all know about downtown office space, in any market across America, although very different in Europe, by the way. I read that this week. But in the United States, downtown office space is certainly challenged. Who knew 4 or 5 years ago that we'd have this wave of work from home and so forth? But unfortunately, that colors the outlook for the whole market because everyone reads it every single day in the paper. Right? What's going to happen with building X or Y and things like that? You have assets that are over-leveraged. When money was so cheap a few years ago, even people took loans to build, particularly like large multifamily developments. They took it at 2% interest, thinking, and then they predicated the rental increases and so forth on that. And guess what? When they go to refinance it at the end of 5 years, what happens? We're in trouble now. Even if that asset is 98% leased, suddenly the cost of money goes from 2% to 8%. your assets underwater, your water. So that's a problem as well. Equity requirements of banks and refinance terms, I'll touch on that as well. Interest rates, and then as I said, sitting in your wallets. And just a gap between sellers and buyers on the investment sales side, between expectations. Like most sellers, this is kind of a funny thing, most sellers sit and expect the pricing that they could have gotten a year ago, right? That's in your head. Your head like, well, I could have got this, $4 million for this building a year ago. Why isn't it worth it today? I'll just sit and wait. What do the buyers think? I want the price to be 50% less because I hear that's what the market. So what's the consequence is everyone just kind of sits on the sides and waits. It will resolve. This has happened before, but those are some of the tailwinds and headwinds in the marketplace. Now, number one, as I've touched on already, is interest rates. Again, residential market impacted very quickly. Commercial market's a little bit slower. Positive news is we hear inflation is slow, and I can't remember what it was this week, like 3.2% or 3.5%. So that's all good, but we have a Fed that's very insistent that we've got to get to 2%. So while last year, just like the airport, right, last year we were thinking about interest rates would come down. Early last year we said at the end of 23. Now we started to say like it'll make 3 or 4 cuts in 24. Now we're starting to say maybe 1 or 2 later in the year. That impacts the marketplace, right? Interest rates are super important. A positive could be it's an election year. Usually governments and politicians like to push money in the election year. At the same time, an opposition party might say, hey, I don't want to push money this year because I want to show that I do a better job when I'm in power. Whatever it may be, could be a positive or negative. You have energy prices that have been fairly modest over the past year. That's a positive as well. And I think there's developments that we don't pay attention to, but things like artificial intelligence. While it's a threat in a way to the workforce, particularly in the technology space, at the same time, it does help put some dampering on wages, right? Because if you're threatened, if it's a possibility that your job can be taken away by AI, you may not be out demanding as much cash and money in terms of compensation. There's other things like that that could be positives in the marketplace. And the negatives is the Fed sticking to their guns. It's an election year, as I mentioned. There's just global uncertainty. We hear that every day. And unemployment, we were just chatting about this in the front row here a moment ago, unemployment is super low. It is hard to get workers in some parts of the country, and for some industries, it's really impactful. The chart there just simply says Urban Land Institute does a fall report every year called Emerging Trends in Real Estate. Number one concern you see is interest rates and cost of capital. Number two is availability of labor, weighing super heavy on the commercial real estate market today. All right, cap rates and financing, more headwinds, so it's a little on the negative side. We're still in that stagnant phase of the market. Remember what I just said, the seller's waiting for the price of a year ago, the buyer's waiting for what they think will be the price of the future, right? So basically the market just stalls. It doesn't mean it's a bad market. This isn't a market like 2008. It isn't a market like the early 90s, if you were around then. It's a market of just sort of a pause caused by interest rates. It is not a market condition caused by overbuilding and some of the other factors that have impacted commercial real estate. It is a market simply of pause as a result of interest rates. And what the chart is really showing you is the gap between cap rates, which is the point of sale return on the investment at the time you acquire the property, and interest rates is very narrow today. It's very narrow. So if you can, look, we can all put our money in money market funds today and get 5%. If the cap rate on the real estate asset is 7%, is that worth the risk? Is that worth the risk? Maybe, maybe not. Maybe you feel like there's a great upside potential in rents and things like that. But when that cap rate gets really small, which is what you're seeing on the far right side, and by the way, that's across all asset classes, office, industrial, retail. When it gets so small, it causes, as I said, it causes a pause in the market price. Because either the prices have to come down to put the cap rates higher, or interest rates have to come down to get movement in the market. So that's kind of where we're at today. All right, let's talk a little bit more about some positive things. Housing demand, I'm sure we'll hear about this a little bit later, but housing demand across the country, we'll see what 2024 holds. But there seems to be a shortage of housing. We read about it a lot. That's a demand for land and development. And once you develop houses, what comes next? Retail development, right? So it's good for commercial real estate. What else? Let's see, affordable housing shortage, that's also a demand. There's a lot of push in markets around the country to build more affordable housing, but that's commercial real estate development as well. And then there's the population shift, right? There's no doubt, and I'll show you a chart, I think it's this next click, if I remember right. Population has shifted, but this chart is actually kind of interesting about housing demand. This is what I forgot about this one. But look, this is Zillow's projections for the positive housing markets in 2024. Where are they? They're all in what we might have called in either the Sun Belt or the Rust Belt, right? I think what's number one there? Buffalo, New York. Who would have thought Buffalo, New York would be the most, but it's primarily because of affordability, right? It's affordability in the marketplace. So I think the weather here is a little better than Buffalo, New York. I'm not 100% sure. But if you can't, if you're in Southern California potentially and you say, I want to own a home, Buffalo, New York is quite affordable. And in today's work from home, I'm not going to say Buffalo's a garden spot of America. No offense to anybody from Buffalo. But, people are moving around. And where people move, there's real estate and commercial real estate activity. All right. And then the other is there are consumer trends. I think I read today this morning that Dollar Tree is going to be closing something like 1,000 stores. Anyone else read that today? So I see some nods out there. So it's so forth. But the truth is, Dollar Store may be closing, but then there's other trends that come up. So there's trends such as pickleball. Pickleball's everywhere, right? So let me just keep going on some other headwinds in the market or tailwinds in the market. We have healthy fundamentals. The retail market I just mentioned, the industrial logistic market I mentioned, medical office. Seems to be a pretty darn good, population's getting older. The distribution system of medical and hospital and medical services is more spread out than ever now into dialysis clinics, remote offices, and things like that. It's a positive. And land sales. I will tell you right now, Coldwell Banker Commercial nationally, land sales is about 20% of our business. It has really, really spiked across all markets, primarily to serve most of the sales are either industrial or they're residential in focus. And there's also just, the institutional market sitting out there waiting to spend. So I know I'm going to be short on time, so I got to go through this, but this chart on the right with the red line is the industrial vacancy rate. Just follow that from CoStar. Yes, it's going up, but if you look to the right of the vertical bar, it's coming back down, right? So as I said, 0.5% to 3%, don't get too panicked about it. It's okay. If I was in office space, that's certainly a different story. And then you have headlines like these, companies and foreign investors looking to come to the United States. So those are all positive tailwinds in the marketplace. All right. I think I have just a few minutes. I'll tell you a couple things. First of all, Coldwell Banker Commercial every year puts out 2 reports, actually put out more than 2, but 2 outlook reports. Last month we put out our commercial real estate outlook. You can get it on our website for free. You can download it. If you don't like to read, we have a podcast, CRE with CBC Worldwide. I did a podcast recording a couple weeks ago talking about the outlook for 2024, many of the things I just mentioned. And we have a number of places on social media where you can just kind of catch if you're one of the fast finger people, you can simply catch the headlines by flipping through our pages across the board. And our report's a little bit different than what you might read from some other firms because what we do is we talk to our professionals in markets like Victorville and any markets. We ask them, what's going on between your conversations with clients? And then we go back and look at the statistics. And we go back and say, okay, let's put that together, as opposed to simply reporting vacancies and things like that. We really do a grassroots kind of approach. Just 3 quick conclusions from that report that I'll highlight for you. 1, cash is king, right? I had just had a conversation with one of our local professionals here, and it's the story is everywhere, right? Getting deals financed is a challenge. Sometimes SBA loans can be the answer. And again, going back to the headlines scare people, and banks in particular have a certain, no offense to anyone in the lending business here, there's a certain amount of herd mentality in the lending, like, oh, I heard everyone else is pulling back, I'm going to pull back too. I'm going to up the requirements, I'm going to up the equity. I understand, they're trying to protect their shareholders. I understand, it makes sense. But right now, if you're a cash buyer, cash is king. For sure, cash is king. Doesn't mean deals aren't being done. It just means they're taking longer to get done because, as the hallway conversation I had right before this, more requirements. The bank, I need more, more equity. I need more proof, and so on and so forth. Deals are taking longer to get done. Number 2 is sales and inventory are down. No surprise. That doesn't mean there's not property on the market or property out there to buy. It just means, as I said, the one party is sitting back looking for the price of a year ago. The other party is standing there saying, I want the deal of the century. Causes a little bit of shortage. Different than the residential market on the commercial side, but some of the same dynamics come to be. And then 3rd, just keep in mind that what is true at the national level or at the headline level doesn't necessarily translate one for one to the local level. Right? So when we see the headlines about office space in Manhattan or Chicago or downtown LA, yes, there's some implication to what happens in this area. it's not necessarily a one-for-one, right? Because the decisions in most of those markets are because big corporates are pulling back on square footage, right? Because everyone's going to work from home. But that local real estate office or the local law firm or the local accounting firm, they're still in the office like they've always been. The medical office, that's why one of the reasons the property type is hot is because, yes, virtual medicine's okay when you have pink eye, but if you really have an issue, you need to go to the office, right? So medical office is still a strong segment. And then local retailers, as I said, pickleball entrepreneurs, doesn't matter what it is. Dutch Brothers Coffee here? I haven't tried it yet, but I heard it's like the biggest thing since sliced bread. I haven't tried. So there's always a new concept. QSR is what they're called, quick service retail. They're always out. There's always a new concept. So don't, take the dollar store headline with a grain of salt, because in another part of the world, the market's doing okay. And then last, I'll leave you with this. We concluded in our report this year, it is a year of caution. That's all. We're not saying, and maybe that's a safe rule, but think about the airline. Think about the analogy I gave you at the beginning on the airline is, you don't really know if we're going to have a soft landing or there'll be a surprise. We probably feel like we're just moving along the point we're at. We're not really going to get any worse. But we're not going to be too optimistic about things really improving. Okay, so that's our outlook in the year 2024. I know you'll have some experts talk about it locally a little bit later. Please just take with a grain of salt what I said about flying. I'm flying this afternoon, so it is what it is, right? We all have to get places, and hopefully I'll get home on time. So thanks very much for having me, and I look forward to the rest of the event.
Thank you.